What's good, everybody? Hope everybody is doing well on this Wednesday evening. Back at it again. It's another day in the market, so I hope everybody was excited. We had some red today, but that's okay. That's nothing new. We've seen a lot of red. We have seen a lot of red this year. So us having a red day really is not that big of a deal right now in my eyes. It's something that we need to get used to. But it's okay though, because this is an opportunity for us to invest, an opportunity for us to be successful. I'm setting everything up right now, getting everything up on Instagram, getting everything set up on YouTube and whatnot. I appreciate everybody for tapping in this week. Please like and please subscribe. I would really, truly appreciate that. Make sure you share this out with a few people that you know that need to have this information. My phone just went crazy right now trying to log in on Instagram, but it's okay though. Nothing is going to slow us down. We're still going to get the information out to the people. That's okay. That's okay. Please reach out to me in the chat. Let me know who all is in the chat right now. Let's see who's in the chat right now trying to get some information. What's good, Instagram? Getting everything set up over here. What's good, everybody over here on Instagram? Right now, I'm on YouTube Live, about to go through my weekly podcast. So please come over on YouTube so you can see me share screens and see me go through the charts and everything, go through the fundamental analysis and everything. So again, I appreciate everybody for coming back in here again. If you don't know me, if this is your first time tapping in, my name is Devon Elder, 28-year-old civil engineer, and I've got the Trade for Yourself podcast, where the mission here is very simple. I just want to help y'all learn how to trade for yourself. Trade for yourself, invest in the stock market, whatever you need to do to be successful in the short term and the long term. So please please subscribe. Make sure you hit that notification bell so you can be in the know every time I drop an episode. So today's topic, Amazon and Google are about to split their stocks. Now what? We understand that these companies are about to split their stocks. We understand that they're big in terms of market cap, right? But, what does that really mean? Just because they're splitting their stock, should we be investing in the stock just because they're splitting the stock? And is the company undervalued or is it overvalued just because the stock split? So first of all, before we get into anything, let me just go ahead and explain what a stock split is. So a stock split is just when a company takes a share of its stock and splits it up into multiple pieces. Now, Amazon and Google, they're both going to be doing 20-for-1 stock split. So you can just look at it as if it's a pizza, and they're going to break each one of the companies. They're going to break their shares up into 20 different pieces. All right. So, the shares are going to be divided out equally. And so we're going to talk about Amazon as a company. We're going to talk about Google as a company. And we're going to see if we should really be investing in these companies in the first place. So let me go ahead and share my screen real quick here so we can go ahead and get started with what we need to talk about today. So before I get into it, let me check the chat out real quick. Condrez White, what's good, man? John Wright, what's good, man? I'm glad you're here to learn. Jordan Cuzzo, the split's coming. Yes, the split is definitely coming. So before we get started, we got to start off first. We got to start off first with the chart, okay? Shout out to my cousin Justin. What's going on, cuz? So we're going to start off with the S&P 500 because I want to put some things into perspective on what we've went through the last week. So we had 1, 2, 3, 4, 5, 6, 7. We had 7 consecutive down weeks on the S&P. That was, I want to say the Dow had like 8 consecutive down weeks. I want to say they said that was the longest that the Dow has been consecutively down since the Great Depression. Now we are not going into a Great Depression. Okay, that's just not how I feel. You know, a lot of media pundits, CNBC and Bloomberg, they'll have a lot of these media pundits come on here and they'll talk to you about Armageddon. They'll talk to you about the world's about to end and all of that. And we're not doing all that. Okay. The world's not about to end. Okay. The stock market is not about to go to zero. Okay. We're just going through a bear market. We're in a bear market and that's okay. But we did have a big positive week. And we had, in the last week on the S&P 500, we had a 6.5% increase in 1 week. And that's the largest increase that we've had since November of 2020. So we had a good increase. So the bottom was at the level of 3,810.32. That was the bottom. And then we had some relief. Now, as I've talked about before, we've been in a defined downtrend in this last year. Okay, we're now in June. Today's June 1st. So since January 3rd, January 4th, we've been in a defined downtrend, a series of lower highs and lower lows. So we bounced off of this level and we had, that high. Okay, we had this high.
Okay. Let me know if there's anything else I can help you with.
Siri going crazy right now. Please don't mind Siri. Man, lost my train of thought. So, like I said, we had a low and then we came up a little bit. And so this could be the beginning of an uptrend. But in order for this to be the beginning of an uptrend, we cannot go below this 3,810 level. If we go below this 3,810 level, then we are then going back down into the downtrend. We have to go up. So right now we're at 4,101. We have to come back down. If we came back down to 4,000 and then we went up to about 4,300 and then came back down, then keep going up, keep legging up. That's what we need to do. We need to have a series of higher highs and higher lows, not lower lows and lower highs. Well, we got to be able to reverse this trend. Okay. If we can reverse this trend, then we can put ourselves into a position to be successful. Now, since we talked about the S&P 500, let's talk about Amazon and let's talk about Google. Now, Amazon, I have done a video on Amazon, a stock analysis video. Please go check that out. Okay, because I did a pretty good breakdown of Amazon stock. Now, Amazon has really been on a pretty bad downtrend pretty much over the last year. Amazon was consolidating from about July of 2020 all the way until we got to March 2022. So pretty much over almost a 2-year time span, Amazon was just straight consolidating. It was just straight consolidating, and then it broke down because it had bad earnings. But Amazon's $1 trillion company. Okay, it's $1 trillion company, and it's got so many different businesses, and the growth is going to be astronomical, I believe, over the next 3 to 5 years for this company. Now, this stock closed at 2,433.68. That's what it closed at, and it's going to be doing a 20-for-1 stock split this Friday. So based on this split adjusted price, if we did the math right now, Amazon will be trading around $121.68 to be exact. So you can expect Amazon to be at around $125, $130. Okay, so I personally think that Amazon is undervalued at this price. I'm going to tell you why. So I went to the Amazon research report for Zacks. Now, I have a Fidelity brokerage account. Now, there are many different brokerage accounts that you can use. You can use E-Trade, you can use Fidelity, you can use TD Ameritrade, you can use Charles Schwab, you can use Webull, you can use, in some cases, Robinhood. There's so many different brokerage accounts that you can use. Now, you don't just got to have one, you can have multiple. The reason why you have multiple is because you have certain different reasons why you would use your brokerage account. So I'll just talk about what I do. So I have a Webull account. Webull account, I do my day trading and my swing trading in my Webull account. I've got my E-Trade account. That's where I trade my long-term options. So I still do trading in that account. I got my Fidelity account. That's my long-term growth account. Okay, it's my long-term growth account. My Charles Schwab account, that's going to be my income account. So that's going to be the account I'm going to start trading covered calls in that account. And that content is going to be rolling out over the channel, over time once I really fine tune this area. But to make a long story short, every brokerage account has different tools that you can use for free, right? Like you can get research on companies, research on industries and sectors and all of that for free. And so and I really truly like this because Zacks is a very respected research institution, and Fidelity is giving me some pretty good free research right here. And so with this research, we're looking at, it'll tell you about the summary of the company. In this summary, it tells you about, what Amazon is doing. It's telling you Amazon is gaining on solid prime momentum owing to ultra fast delivery services and strong content portfolio. Further strengthening relationship with third-party sellers is a positive. Also, growing momentum across Amazon Music is contributing as well. Additionally, strong adoption rate of AWS, Amazon Web Services, aiding the company's cloud dominance. Also, expanding AWS services portfolio is continuously helping Amazon in gaining further momentum among the customers. Further robust Alexa skills and expanding smart home products. So, your cameras and all that different type of stuff. That's positive. Additionally, the company's strong global presence and strong momentum among the small and medium businesses remain tailwinds. However, growing expenses associated with supply chain constraints and labor supply shortages remain concerns. And the stock has underperformed this industry on a year-to-date basis, which is what we talked about before. Now, like I said before, with the supply chain constraints and the labor supply shortages, that's the risk that we have in Amazon. But I'm willing to bet you that risk is only going to be a temporary risk. Okay, so as I talked about, this is $1 trillion business, $1.1 trillion. And so the one thing that I really want to show y'all is the EPS estimates. Okay, so EPS is your earnings per share. That tells you how much money are we generating per share. Okay, that's the money. Okay, as investors, that's the number one thing we care about. We care about what the profit is because the business's number one objective is to add the value to the shareholder. Okay, that's the number one objective for it. And so when we look at these EPS estimates in 2021, Amazon gave us $64.81 per share. That was the total year value. Now that was great. This year, not so much. And we're definitely estimated to only get $10.85 per share. But that's because of the amount of headwinds that the company is having to deal with right now, dealing with a lot of headwinds. But in 2023, we're expected to come back up to $54.81. That's a 5x increase in terms of EPS. So what that tells me is that if I can buy Amazon at $121 once they split that stock, that tells me that I am getting Amazon on a major discount. And if I can hold this stock for the long term, over the next 3 years, 5 years, 7 years, I know I'm going to be rewarded because Amazon is not going to stay down for long. Trust me, Amazon is too good of a business and too big of a business to fail. And so what I really like about Zacks is that it gives you the research report and all that type of stuff. It lets you know what the business is in. And right here, let's look at this consensus estimate of what the EPS is going to be. And we're going to be able to look at this over the 3-year time span here. So I'm going to zoom in a little bit so we can kind of understand what we're looking at here. Okay, man, this right here gets me excited right here. So this right here is a chart. This is showing us what the EPS estimate is. So in 2022, This is a chart looking at stock price versus EPS. So the stock price is on the right, EPS estimate is on the left. So right here in 2022, there was an estimate of about $65 per share in terms of EPS. And now the estimate is really trending downward. And right here in about the beginning of 2023, we're looking at right about $10 a share, right above $10 a share, which is what we looked at on the previous slide. But look at 2024. We're back up to about around $55. And then 2025, we're looking at above $85 on the EPS. Now, from where we are right now, you're talking about 8.5 times bigger in terms of what the company is doing from an EPS standpoint in terms of generating that level of profit. That's something that we really truly have to pay attention to. Okay. Look, we need to be getting Amazon right now. Okay. Because the business is just too strong. Management is too strong. And I'm telling you, the AWS, the cloud domination is really what's going to be able to get this business up here, because we understand where we're going. We understand that Amazon is a logistics company. Okay, so that's something that we need to pay attention to and really tap in with. Okay, and then we've got some reasons to buy right here. You know what I'm saying? I really truly encourage y'all to go and really look at this, the risk. Like, if you really want to research any business, this is where you need to go. Open up you a Fidelity account for free. You don't even have to put any money in there if you're not ready to put any money into it. Don't do it. Just take your time and just get the account so you can get the research for free. Okay, like these brokerage accounts are working for you, right? That's the main thing I really want to point out when I'm showing y'all this research report. These brokerage accounts, they're working for you, so use it to their advantage. Also, these brokerage accounts, they operate on customer service 24/7. So you can ask them any question that you want to. Look, you're using their platform, so just be able to utilize it to the fullest extent that you can use it. So yeah, like for real, get you a Fidelity account and go through this research report so you can really truly understand what Amazon is getting ready to do. Now, since we've looked at Amazon, let's go to Google real quick. Let's look at Google. Now, Google, the story around Google is a different story. This chart right here looks beautiful. Okay, this is a beautiful chart. And to be honest, what I really want to do is I really want to put an info line on here, and I want to see what has the return been for Google over the last 5 years. I want to look at this over a weekly chart. What has it been over the last 5 years? So I'm drawing this info line on TradingView right now. And as of today's close, Google has had a 130% return over the last 5 years. Now, there's a big reason for that, because Google is a very, very respected business. Okay. And we're going to get into Google because I haven't really done a Google breakdown yet, but I will do a Google breakdown in the future. Right now, I really, truly just want to show y'all what's going on. So if we look at Google, Google is in the consumer services sector. It's not in technology. It got reclassified a few years back with Facebook and with Netflix and all. So it's a little different, but the closing stock price that Google had was $2,277.84. Now, Google is going to be splitting their stock on July 18th, and they'll be doing a 20-for-1 stock split as well. So if we look at that stock split, we break it down, you'll be able to get Google for $113. So you can round up to 115, 120. We don't really know where the stock will be in 6 weeks, but this is another company that you can get on another discount because I'm about to show you why. So let's go to Google's research report here real quick to really show you what's going on. Now, with Google's research, Google is another great company. Now, let's go through Google's summary. Alphabet, right? Alphabet's strong cloud division is aiding substantial revenue growth. Moreover, expanding data centers will continue to bolster its presence in the cloud space. Further, major updates in its search segment are enhancing the search results. Moreover, Google's mobile search is gaining solid momentum. Also, strong focus on innovation of AI techniques and the home automation space should aid business growth in the long term. Further, its deepening focus on wearables category remains a tailwind. So Google is really a technology company that is in a lot of good industries, okay? And furthermore, the company's growing efforts to gain foothold in the healthcare industry are other positives. That sounds similar to Apple, another multi-trillion dollar business, okay? Also, Alphabet's expanding presence in autonomous driving space is contributing well. I really encourage y'all to Google Waymo, Google Waymo, which is Alphabet's subsidiary. Look at what they are doing on LinkedIn. They are really driving. People are really riding in the cars in the back seat, and the car is really just driving itself. Okay, like it's really crazy to look at when you see Waymo. Okay, so notably, the stock has outperformed its industry over a year. However, its growing litigation issues and increasing expenses are concerned. Now, this is another risk, okay? Antitrust litigation, Google being so big, Google having the Google store, and then being able to have the Google phone with the Android software, because you really only have two operating systems. Either you're operating on iOS or you're operating on Android. There's no two. There's really no other ones you can really operate on. Either you're operating on the App Store or you're operating on the Google Store. It's really one of the two. And that's what makes Google so powerful. Now, Google is a $1.4 trillion company, so it's a little bit bigger than Amazon. I believe it's the third largest company in the world. I believe Amazon's the fourth largest company in the world. I think Tesla's the fifth largest company in the world, or somewhere in that order. But the main thing I really want us to look at is the EPS, okay? Because that's the profit that we're generating, and that's telling us if we are able to get this business on a discount. Google is really one of the cheapest companies from a valuation perspective. It's really one of the cheapest companies from a valuation perspective on the stock market, especially when you're looking at technology companies. From a valuation perspective, it's cheaper than Amazon, it's cheaper than Tesla, it's cheaper than Microsoft, it's cheaper than Apple. And it's going to be able to give you that level of profit that you need. So in 2021, we had Google. Google gave us about $112 per share, which is ridiculous. It's ridiculous because you got to understand, Google is killing it from an advertising perspective, because you got YouTube, you got the Google search, generating a lot of money, a lot of ad revenue, especially throughout the pandemic when everybody was shifting online and going to the e-commerce, which that trend is still going to be going up and to the right, I believe, even though the growth may be a little bit subsided. And so this year, 2022, they're expected to have $112.62. Now, that's not that much higher than where it was last year. And that's really the reason why the stock hasn't performed that much. That's why the stock hasn't performed as well as what we expected it to, because the growth has been stagnant. And we know that as a Wall Street investor, you are paying for earnings in the future. Okay. If a company comes out and tells you that my earnings are expected to be about what they were last year, a company's not paying for that. They're going to bring the stock on down and they're going to really try to get you at a cheaper price. And that's the thing about this game. And that's why I really, truly love this game, because it gives you the ability to get assets on sale. It gives you the ability to be able to increase your net worth and get things on sale. It's like going to the store. It's going to the store, being able to get 2 for 1. You know what I'm saying? That's the types of thing that you have to think about as an investor. Now, in 2023, the annual estimate, we're looking at an increase of about $133 per share for the total year. So now we've got an increase. We've got about a good more than 10% increase on what the EPS is looking at. So now we're going to pull up again. We're going to pull up, okay, what this consensus estimate is. Now, we've got right now, we're looking at the consensus estimates. We're a little bit above $110, $112 per share. But by the time we get to 2024, we're going to be above $130 a share. By the time we get to 2025, we're going to be upwards of close to $150, nearing $160 in terms of EPS. Now, this right here is really going to give us a good opportunity to really truly be successful, because Google is a business that has multiple wings, just like Amazon. It's just in a different area and different perspective. But the one thing I want us to look at, though, is that Amazon and Google are both competitors. Why? Because AWS is the largest cloud provider in the world, but Microsoft is right behind AWS, and then Google is right behind AWS as well. Okay, now A&D is one of my favorite companies, one of my largest holdings. So this is going to give me an opportunity to talk about A&D. The reason why I like A&D is because A&D is providing the chips for all three of them. For all three of them. These are trillion-dollar businesses that A&D is inserting themselves. They've got relationships and they've got partnerships. So I don't even have to be in the same industry as you to be able to eat from all of y'all. Okay, so that's what you got to understand. You've got to understand that we've got to be in businesses that are leaders in their industry, and they are able to make strategic partnerships with competitors, and they are also able to make strategic partnerships with other technology companies to be able to grow the business, because we understand that we can get better and we can get farther with collaboration versus competition. We understand competition is just a part of the game. We get that. I understand that. But, Google and Amazon are two businesses that just have so many wings. Like they have so many different wings. Like if you look at Amazon, Amazon has Alexa, and they have their front door cameras and the indoor cameras, and the Amazon Prime Video and all of that. Google's got Google Nest and it's Google Home, and you got your YouTube, which they're even trying to monetize YouTube even more crazy and really expand themselves in that podcast network. Hence the Trade for Yourself podcast. You see what I'm saying? That's why I'm over here on YouTube, because I understand what the growth can be in the future. Like these spaces are really truly getting tight. They're getting tight. But let's talk a little bit about Google, since I really haven't talked about them that much. Alphabet is one of the most innovative companies in the modern technological age. Okay, so we understand what they've done from a search engine perspective. We understand what they've done with Google search and mobile devices. The Google Cloud platform is really going to really take them to the next level, because now they're getting into the Google Cloud platform and the services, which is a business that's going to continue to grow and be large. Now, last year, Google had about $257 billion in revenue last year, which is up 41% from 2020. And the company reports revenue in three broad heads: Google Services, Google Cloud, and what they call other bets. Now, Google Services is generating them about 92.2% of revenue. That's where you're getting your ad revenue from. That's really where you're getting your ad revenue from, and other services that they have to really build out their network. You've got your Google Cloud, which, storing everything in the cloud, and then your other bets. You know what I'm saying? So that's really what I like about this business. Okay. So like I said, eventually I am going to drop a full breakdown of Google. But like I said, please get you a Fidelity account. And hey, go to Zacks directly. Go to Zacks.com directly and really truly get you some research, because if you really truly want to tap in and be a great investor, be a dope investor, you're gonna have to be able to think like an investor and have that research. And so you want to be able to utilize the tools that the institutions give you for free. That way you can have the ability to be able to read it for yourself, understand it for yourself, and be able to make decisions. So really, truly keep an eye on these two stocks, Amazon and Google. It's an opportunity to get some stocks on a deep discount. Like, I don't know if trillion-dollar businesses has split their stocks in this close proximity. Amazon splitting theirs Friday, Google splitting theirs next month. I don't know about y'all, but I'm gonna have to tap in. I'm gonna have to tap in. I'm gonna have to shave off some dollars. I'm gonna have to cut some things back to make sure that I can build some strong positions in these companies over time. So y'all just keep that in mind. Now, if y'all have any questions, please reach out to me in the chat. Reach out to me in chat. This is always an interactive, platform. So if you got some questions, reach out to me in the chat. But if I'm gonna wait a little bit to see if we do get some questions. But before we get out of here, let's talk a little bit about what's going on with the U.S. economic calendar. So we talked a little bit about job openings today. The S&P Global U.S. Manufacturing that came out today. But Friday, we're going to get our job numbers. So Friday, we're going to get our job numbers. We're going to get our unemployment rate, average hourly earnings, and we're going to get our labor force participation rate. Now, and we're also going to have the Federal Reserve Vice Chair, Lael Brainerd. She's going to speak Friday as well. Now, I don't really know how the market is going to feel about whatever the number ends up reading on Friday. Like I have no clue. The market's hot one day and cold one day. So I don't really know how to really feel about that. But at the same time, I do know that we're going to have a lot of volume probably coming in from a trading perspective on Friday because it's jobs day and the jobs numbers always moves the market. That's just what it ends up happening. So, but what we really want to tap into is next week. Now, next week is going to be a very, very important number. Now, next Friday, we're going to have our CPI number. Now, I've talked about this before in previous podcasts. We've talked about the CPI number, the Consumer Price Index. This is a measure of inflation on the consumer side, not from the producer side and not what the Federal Reserve looks at. But I will guarantee you the market is going to move very wildly off of this number. Now, you're going to want to watch what they see in the CPI number year over year. That's what they're going to care about the most. Okay. 8.3% is high. It's high. I think it might be higher than what it was last month. I'm not even sure. But this is what I want to tell you. If this number is 8.3% or higher, I think we're going to go lower. I think we're going to go lower. We may retest the $400 level on SPY, maybe lower than that. It's a possibility. For my long-term investors, this will give you an opportunity to buy some more of these stocks on sale. Okay, that's the one thing you can look at from a positive perspective. From a trader's perspective, I want y'all to sit back and wait. Don't put on too much size. Getting you some day trades. Day trade like you normally do. Don't get too crazy because what can happen though is that we're going to have a lot of volatility on this day. So this could really truly give you an opportunity to make some money. Okay, because volatility is not a negative or a positive thing. It's just, is it going in your way or is it going in the opposite direction? That's all volatility is. Now, for the market to go up, in my opinion, I think we really truly need to see CPI come below 8%. If we can get CPI in like 7.9 or 7.8, that could really truly show that inflation is peaking, because the reason why we've been so negative in the market is because of the high inflation. And so the Federal Reserve has been using their tools to pretty much try to make sure that we can have that price stability, understand that price stability, which is a part of that dual mandate that I have to keep putting out there, because I have to keep reiterating that so we can understand as investors how important the Federal Reserve is in terms of what we need to be looking at if we're going to be investing in the stock market. So before we get out of here real quick, let's go over this choppy day. So to begin June, we had some sentiment that came out from Jamie Dimon. JP Morgan CEO Jamie Dimon on Wednesday said the economy is headed for a hurricane. You better brace yourself, Dimon said at a financial conference. JP Morgan is bracing ourselves, and we're going to be very conservative with our balance sheet, right? One factor that's worrying Dimon, he said, is the Federal Reserve tightening monetary policy by raising rates and reversing stimulative measures implemented at the onset of the pandemic. Wednesday marks the start of the Fed's plan to reduce its balance sheet which ballooned to nearly $9 trillion during the COVID pandemic. Now, the tool that the Fed used was being able to print money and be able to buy bonds and buy assets. And that was able to put some relief on the economy because they had those assets that they would be able to hold on their balance sheet. Okay, so understand that. But at the same time, though, the Federal Reserve has to sell off some of these assets so that way they can have some buying power and they can have some tools to be able to help the economy recover if need be. Now, on CNBC, they talked a lot about this economic hurricane, weighing on investor sentiment and stuff like that. Of course, they're going to say something like this, okay? Like, don't let this fear rhetoric scare you, okay? Like, don't let CNBC come on the TV and tell you certain things to scare you. Like, look at the data, look at what you see. Like, trust me, I'm not sitting up here saying that the economy is operating on all cylinders and we are going into a recession and we're not going into a recession. Prices are high. Okay, prices are extremely high and people's pockets are being depleted. Okay, so I understand that 100%. But like I said before, we're not back in the Great Depression. We're not in the 1920s. We're not in the 1930s. That's not where we are. Well, we're not even in 2008. The housing market, yes, is top heavy, but people are not really defaulting on loans, and we don't really have high numbers of foreclosures. We don't have a high number of people being able to purchase houses that they can't afford because of the amount of regulation that we have right here in the real estate market. So that's not worrying me. The one thing that I'm keeping my eye on is that the recession could come and that we could have a break and we could have a break in the stock market and come down even further. But something tells me that the bottom is already in and everything that we could have from an economic standpoint may already be priced in. So as we go out through these next weeks, we're going to keep all this stuff in mind. We're going to make sure that we understand what's going on out here in the economy so we can continue to make sure that we be successful out here in the market. So I appreciate everybody for tapping in. Please like, please subscribe. Please make sure you like and subscribe because it really truly helps the channel. Please make sure you hit the notification bell so you can be in the know every time I drop an episode. And I'm going to tap in with y'all next week. And remember, don't pay for it. Trade for it. Catch y'all on the next one.